Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our second quarter market review and outlook report. With most major domestic and international stock market indexes having fallen more than 20% from their highs, these indexes have entered into what is referred to as a bear market. This year has been especially painful for investors as even bonds have been under intense pressure, with losses exceeding 13% at one point. The reasons behind the drop in both the stock and bond markets are numerous. Sharply rising interest rates, inflationary data not seen in 4 decades, the Russian invasion of Ukraine, which has destabilized the global oil and grain markets, and the zero COVID policy of the Chinese government, which has further exacerbated stalled supply chains. Additionally, coming into this year, stock prices were elevated after a strong 2021. This perfect storm of events has led to concerns of both ongoing inflation and the possibility of recession, sometimes referred to as stagflation. With this as the current market backdrop, investors are asking 3 basic questions. Number 1, when will the stock market bottom? Number 2, when will inflation peak? And number 3, are we going into a recession? Regarding the stock market, since 1928, the S&P has experienced 26 bear markets. The average decline was 36%, and the average length of time was 289 days. While there's no way to determine the exact date of the equity market's hitting bottom, we believe that the index will stabilize once there are clear signs of inflation peaking. Also, with stock valuations based on forward-looking earnings projections for the S&P 500 falling below their historic average, any additional confidence in those earnings forecasts will likely lead to more stable stock prices. Conversely, investors may react negatively if earnings estimates are reduced and valuation accuracy is questioned. From a contrarian standpoint, a poor reading on the most recent University of Michigan Consumer Sentiment Survey may serve as a leading indicator of rising future stock prices. The Consumer Sentiment Index for June showed a reading of 50, which is below its historical average of 86 and a new all-time low for the survey. When the survey results have reflected this level of excessive pessimism in the past, 12-month stock returns have been quite strong. As to when inflation is going to peak, inflation data has remained stubbornly high this year as energy, food, housing, and other related costs continue to squeeze consumers. The Russian war with Ukraine has clearly created major dislocations in the oil and gas markets and has also disrupted food supplies, fertilizer production, and further obstructed global shipping routes. Unfortunately, a protracted conflict is a real possibility and may maintain pressure on prices for an extended period. However, any resolution of the crisis would likely provide immediate relief to the food and energy component of the consumer price index. Additionally, the ongoing China zero COVID policy has caused multiple disruptions to global supply chains as the Chinese government has been quick to shut down entire cities at the first sign of a COVID outbreak. Any signs of COVID lockdowns abating in China will likely bode well for easing supply chain bottlenecks and therefore reducing pricing pressures as more goods become available. Further, the Federal Reserve has been slow to attack inflation, but is now raising interest rates aggressively to curb consumer demand. Now that the Fed is laser focused on fighting inflation, markets have reduced 5-year inflation expectations. This is certainly an important change in investor psychology that may help stabilize markets. The markets now seem to be more concerned with whether the Fed will overshoot on hiking interest rates and put the economy into recession. There is little question that economies around the globe are seeing lower GDP forecasts and risk are rising as central banks increase interest rates to fight inflation. The question regarding whether the U.S. is going into recession is an important one as it directly impacts corporate earnings projections and therefore the stock market. The official arbiter of determining recessions is the National Bureau of Economic Research, and they consider multiple factors, not just GDP, in determining whether we're actually in a recession. Despite historically low consumer confidence today, unemployment is near historic lows, and wages are rising at the fastest rate in 40 years. Consumers are still traveling and spending money, and their personal balance sheets are still healthy. In addition, while we are monitoring corporate earnings projections for any changes, overall estimates for the next 2 years remain strong despite some recent negative revisions. Corporations are also flush with cash and have been increasing stock dividends and stock buybacks at a brisk pace. In sum, there are no certainties when it comes to forecasting when the stock market might bottom, when inflation will peak, and when the next recession will come. However, when one considers the already significant pullbacks in the stock and bond markets combined with a financially sound banking system, corporations flush with cash, manufacturing production rising at a 6.6% annual rate, likely peaking inflation in 2022, and a consumer that has both rising wages and multiple job opportunities, We believe that patient long-term investors will be rewarded from these levels. As markets tend to discount expected future events, we believe that the extremely pessimistic forecasts for economic growth and inflation have to a large extent been factored into current prices. And any good news will likely lead to positive returns from here. Thank you for watching today, and I hope you'll enjoy reading our full market review and outlook for greater detail on the second quarter and our forecasts for the rest of 2022. Take care, and we'll see you next time.